Hi, this video is going to be walking through a Black-Scholes option pricing model spreadsheet that I created. I created this one probably about 10 plus years ago when I was teaching an investments class and wanted to have a handy tool to calculate the Black-Scholes option pricing model. The reason for this is if you've ever used the Black-Scholes option pricing model and done any calculations by hand, it can be pretty complex to work through and it can take quite a bit of time. And so having a spreadsheet put together makes it much easier to do these calculations. Just as a quick reference, here is the Black-Scholes option pricing model. You can see here's the formula for the value of the call. This is equal to the price times the area under the normal distribution up to D1. And here's your formula for calculating D1 minus, this is the present value of the exercise price times the area under the normal distribution table up to D2, and here's D2. So in order to do the Black-Scholes option pricing model, you first of all have to calculate D1, calculate D2, go to a normal distribution table and look those values up to get the ND1 and ND2. Then you have to calculate the present value of the exercise price, and then you can finally calculate the value of the call. Once you've done all that, if you want the value of the put, you use this formula down here, which says the value of the put is equal to the value of the call plus the present value of the exercise price minus the current stock price. And going through an example of this in class, granted it's illustrating and trying to explain the calculations, it's not uncommon to spend 30 minutes going through a single calculation. Now, once you've done it a few times, you can probably get it down to 3-4 minutes to do this calculation, maybe faster if you're really good with math, but spreadsheet will do it in the blink of an eye. So it's much, much easier to use the spreadsheet. So let's go back to the spreadsheet. And you can see there are 5 key inputs to the Black-Scholes option pricing model. There is the time to expiration, the exercise or strike price, the current stock price, the volatility of the underlying stock, and the risk-free rate. Those are the 5 key components to calculating the value of an option. Note that whether or not you think the stock price is going to go up or go down does not factor into the option valuation. So whether you think the stock is undervalued and going to go up, or whether you think the stock is overvalued and going to go down, that doesn't matter. That gets captured somewhat by this volatility measure, and we're going to talk about that in a little bit as we walk through this spreadsheet. So in order to illustrate how to use this spreadsheet, we've got a little example here, and we've got the 5 key inputs. Time to expiration. Now that's always given in days, and the reason for that is we want days per year. So that T is actually the number of years that we want. And so if I have 40 days, I know there are 365 days per year. So 40 days would be 40 divided by 365. Now, one question that comes up a lot is, should I use days per year, which is 365, or should I use trading days per year? And that works out to typically be about 252 trading days per year because markets are closed on Saturdays and Sundays, they're closed on holidays. So once we take out all those days the market is closed, it's only open for about 252 days per year. Now that sometimes varies on a leap year or something, but 252 is a standard. In practice, it doesn't matter that much whether you use days per year or trading days per 252 days. They're going to work out to be about the same. That said, I always use days per year in order to calculate the time. And one of the reasons for that is when you get to the last week, doesn't really matter how many trading days are there. If you've got 4 days, you've got 4 over 365 days remaining. So I like to use days over trading days, but in practice, that's not going to make a big difference. So trading days over trading days per year or total days over days per year, not a big deal. Again, I use days over days per year, so 40 over 365. So let's go back and put that in. Now I've got the spreadsheet set up here. The little green shaded are my inputs. So I want that to be 40 over 365. So I'm just going to go up here and change that to 40 divided by 365. And that gives me the fraction of the year. Next, I want the strike or exercise price. This is often symbolized by X, which you can see is kind of a strike. If you've ever gone bowling, that is the symbol for a strike in bowling. And 60 is the dollar value there. So I'm going to put that in. That's a 60 strike option. I just put that in as 60. Next, I need the current stock price. Current stock price is $62 per share. So I'm going to put that in. Now, a little quick side note here on some terminology. This option would be called in the money for a call option, because if the option expired right now, you would choose to exercise it because you have the right, but not the obligation, to buy a $62 stock for $60. If you could do that, you'd be happy to do that because you're essentially picking up $2 free. On the other hand, if it was a put option, it would be called an out of the money option, because a put option gives you the right, but not the obligation to sell the underlying stock for that fixed strike price or exercise price. So if you could sell a $62 stock for 60, nobody would want to do that. You'd rather sell it for $62. So the call option is in the money. If it expired right now, you would choose to exercise it. The put option is out of the money. If it expired right now, you would not choose to exercise it. Next up, we need the volatility. The volatility is our annualized volatility, and that's 32%. Little side note on volatility. A lot of times students will ask, well, how do you estimate volatility? And the answer is it's really tricky to do, because you can estimate what volatility has been, but ultimately what you need to value the option is what volatility will be between now and the time the option expires. Now, I don't know about you guys, but my magic 8-ball doesn't work too well for telling me what's going to happen in the future. I can guess, and one good way to guess is, hey, what's happened in the past is a reasonable predictor of what's going to happen going forward, but it's not a perfect predictor. And there may be something upcoming like an earnings announcement, or maybe FDA ruling on a drug for a biotechnology company. Lots of different things that could happen that are going to affect volatility going forward to make it different than what it has been in the past. Quick idea or general rule of thumb is to estimate the volatility over the past maybe 3 months or 6 months and use that as a starting point, but then stop and think, is there a reason why volatility might be higher going forward or higher going backwards? So volatility, it should be the annualized volatility. Be careful there. A lot of times people will plug in weekly volatility. If you have weekly volatility, you need to annualize that. And just real quick, in order to annualize it, you would multiply by the square root of the number of observations per year. So if you're estimating volatility weekly, it would be your volatility estimate times the square root of 52. If you're estimating volatility off of quarterly data, it would be the volatility times the square root of 4. If you were estimating volatility off of monthly data, it would be the volatility times the square root of 12. So all of those are ways to annualize volatility and get an approximation. Lastly, we have the risk-free rate. In our example here, the risk-free rate is 4%. So let's go back to our spreadsheet and plug that in as 4%. Now, one thing I will tell you on this spreadsheet is if you plug in 4, it's going to automatically move it to 4%. If you plug in 0.04, it's also going to move it to 4%. If you're in an environment where the risk-free rate is less than 1%, which probably is right now, you want to plug in, for example, let's say it's 0.4%. You do 0.4 and then press the percent key. So you've got to specifically tell it it is 0.4%, not 0.04 or 4. It will automatically convert those to percent, but 0.4% would change it to 0.4%. Our example is 4%, so I'm going to click that. Again, the risk-free rate, where do you get that? Best measure is probably treasury bill rate between now and the time to expiration. Now, one thing I'll throw out there is unless you're really moving a lot of options, it's not going to matter that much what your risk-free rate is. The risk-free rate is not that volatile. It doesn't change that much. And honestly, let's take a quick look here. If I change that risk-free rate from 4% to 6%, okay, our call option value is $3.86. Let me change it to 6%, and it changes to $3.94. That's probably not something you're even going to really notice that much on an option, and that would be a pretty big movement in the risk-free rate. So there you can get a quick overview of the inputs. Once you put those in, the spreadsheet is going to calculate all this other information for you. So all these cells here are already calculated, and if you change something, they automatically change. What happens if volatility goes up to 35%? That call option is going to change from 386, spotlight it here, to 409. Go back to 32. What happens if the current stock price goes up to $65? That call option value changes from 386 to 606. So you can see quickly how those values are going to change by just changing the inputs in the spreadsheet. Now, something else I want to mention real quick is the intrinsic value and speculative premium. Intrinsic value and speculative premium are ways to separate the stock price. The intrinsic value is if the option expired right now, what would it be worth? And remember, because an option is the right, but not the obligation, that's an important step in an option. You have the right to buy or sell the underlying, but you're not obligated to. If it's not in your best interest to do it, you throw it away and let it expire worthless. So the intrinsic value can never have a negative value. Worst case, it's 0. Otherwise, it's going to be positive. So in this case here, if we go back to our call, I have the right, but not the obligation to buy a $62 stock for $60. That is worth $2 to me right now, so it has an intrinsic value of $2. Now note the option itself is trading for more than that, and that's because there's speculative premium built in. Speculative premium is saying, hey, the stock can move in my favor and offer me far more upside. So I'm willing to pay more than the intrinsic value for this call option. And so the speculative premium is just the difference between the option price and the intrinsic value. So if the intrinsic value is $2 and the option price is $3.86, that means there's $1.86 in speculative premium associated with this option. Now, one thing I want to mention is the intrinsic value does not mean that's what it's going to be worth, kind of worst case scenario. It could still fall and the intrinsic value could be 0 by the time we get to expiration. It's just saying right now, if the option expired this second, you could get $2 for it. Now, would you choose to do that? No, because if you wanted out of this position, you could either exercise it right now for $2, or you could sell it on the open market for $3.86. I don't know about you guys, but I'd much rather have $3.86 than $2. Therefore, I am not going to exercise my option. If I decide I want out of this position, I'm going to sell it and take the $3.86. Now, if we go to the put, remember a put is the right but not the obligation to sell the underlying stock. So I have the right to sell the $62 stock for $60. Do I want to do that? No. If I can sell it for 62, why would I ever take 60 for it? That's a bad deal. Therefore, if I look at my formula for intrinsic value, now the strike price is 60 minus the stock price, which is 62. That's negative $2. 0 is higher, so the intrinsic value of the put is 0. And we see that show up here, intrinsic value of the put is 0. But the put option is still worth $1.60, so therefore I am going to take that $1.60 if I sell it, and I would not exercise the option now. One of the things you'll note is in both of these cases, if the option has time to expiration yet, you're not going to exercise your option. You're better off selling it in the secondary market, because if you exercise it, you just get the intrinsic value. If you sell it in the secondary market, you get the intrinsic value and the speculative premium. So as long as that speculative premium is positive, which it almost always will be, you would rather sell it in the secondary market rather than exercise it. So in probably 98% of the cases, you are not going to want to exercise an option prior to expiration. If you want out of your position, you would sell it in the secondary market rather than exercise it. So then I want to talk a little bit about the Greeks. If we look at the Greeks, there are 5 specific Greeks, and these are just option sensitivity analysis. Delta measures the sensitivity of the option price to small changes in the stock price. If the stock price goes up by $1, how much should the option go up or the option go down? Now, if it's call, if the stock price goes up by $1, the option is going to go up in value. It's going to go up by less than $1, but it's going to go up in value. If it's a put and the stock price goes up, the option is going to go down in value. Gamma measures the sensitivity of delta to changes in the stock price. So now we're not looking at how sensitive is the option price. We're looking at what's often referred to as a second derivative. How sensitive is the sensitivity of the option to changes in the stock price? And this introduces a concept called gamma neutral hedging. It goes beyond this video, but it's an option strategy that you can use if you expect the stock price to make some large changes in a short period of time that allows you to profit regardless of whether the stock price goes up or goes down. Now, one thing I would caution you with a lot of these trades, oftentimes when people are talking about options trades, they talk about how you can make money off of this. But keep in mind, options tend to be a zero-sum game, which means there's a buyer of the option and a writer of the option. If you're making money as a buyer of the option, the person writing money is losing money. If you're losing money as a buyer of an option, the person writing the option is making money. So you're going to offset. If you're buying the options, you're probably going to lose more frequently, but you're going to have the chance for some home runs. If you're writing the options, you're going to win more frequently, but you're going to end up having some large losses in there. I'm not saying one is better than the other, but you can think of buying options typically, unless you're doing spreads or something like that, but just buying a straight call option or buying a put option, you're trying to hit a home run, you're going to strike out quite a lot, but you're hoping that 1 out of 5 times that you hit a home run, you're going to make up for the 4 out of 5 times that you lose money. If you're writing options, you're not going to hit many home runs, but you're going to pick up a lot more base hits. And so you're not going to make much money. You're occasionally going to take a big strike against you, but over time, you're hoping to make a little bit more money. Now, when I talk about options being zero-sum games. That's really true if you are talking about no transaction costs. However, the reality is you do pay typically brokerage commissions to buy and sell options. There are bid-ask spreads that are going to affect your profitability. And if you make profits in options, you're going to be paying taxes. Now, you can dodge some of those taxes through a tax sheltered account, but I would not encourage anybody to be trading options in an IRA or other things along those lines. Instead, if you're investing, stick with stocks, maybe bonds, mutual funds, things that are going to be more positive sum games where you're more likely to get a return. If you want to gamble it up, YOLO, then options may be fun, but keep in mind it's kind of like a casino as opposed to an investment. So let's go back to our Greeks. Theta sometimes is referred to as time decay, measures the sensitivity of the option price to changes in the time to expiration. As we look at maybe a 3-month option, if a week goes by, it's still 2.75 months. It's probably not going to have a big impact on the option price. On the other hand, if we have an option with, let's say, 8 days until expiration and a week goes by, it now only has 1 day to expiration. That's going to have a big impact on the option. So the longer the time to expiration, the less sensitive the option price should be to changes in time. Time decay accelerates as we get closer to expiration. Vega measures the sensitivity of the option price to changes in the volatility of the underlying asset. So as volatility goes up, the value of the option increases, and that's because there's more chance of an upside. Remember, options we only are really playing half the distribution. If I have an option with a 60 strike and I've got a call, if it goes to 65, that's great. If it goes to 70, that's better. If it goes up to 100, that's awesome. If it drops to $59.80, or if it drops to $5, in either of those cases, I lose my entire initial investment. So I don't care how far it falls below 60, everything below 60 is the same. Not everything above 60 is the same. So I only get to play half that distribution. Everything below the strike price for a call option, if I bought the option, is going to be the option expires worthless. But every extra dollar above the strike price makes me more money. So I want volatility with options. The higher the volatility, the more the option is going to be worth. And lastly, we have Rho, which measures the sensitivity of the option price to changes in the risk-free rate of interest. This one, it's not going to be that important. Let me briefly explain where that comes from. If I go to the option valuation, you can see this formula down here. This is sometimes called put-call parity, which basically says if we know the value of the call, we can tell you what the value of the put should be, or vice versa, but we typically solve for the value of the call first. And so if I know the value of the call, I add the present value of the exercise price, I subtract off the stock price, and that gives me the value of the put. The idea is if I buy a put contract, buy the underlying stock, and write a call contract, that's going to guarantee me, no matter what happens, the strike price. So I can use options in the underlying stock to create a risk-free payoff. No matter what happens, I am going to get the exercise price at expiration. Doesn't matter if the stock goes up or goes down, I am guaranteed to earn the strike price at expiration. I won't earn more, I won't earn less, I will earn exactly that strike price. Well, if that option expires in 3 months and it costs me $59.99 to get into it, and I get $60 at expiration, I'm probably worse off than I was before. My $59.99 is probably worth more today than $60 3 months from now. And so I should earn the present value of the exercise price. That's where the risk-free rate comes into play. So it's tied off of a risk-free arbitrage position that you can create. So let's go back to the spreadsheet, and you can see delta for the call is positive, delta for the put is negative, gamma is going to be the same in each case, theta is time decay, vega is the measure of how it responds to volatility, that's going to be the same in each case, and rho is the measure to the risk-free rate. Notice that as the stock price goes up, the option increases in value for a call, it decreases in value for a put. As the time to expiration increases, the value of the option is going to decrease. Now this is a bit confusing because you see that negative sign, but the time never increases. It only goes down as it gets closer to expiration. So this is just saying that as you lose days, you lose value. Volatility, as the volatility goes up, the option becomes worth more. That's true for calls and puts. And rho, as the risk-free rate goes up, the call becomes worth more, the put becomes worth a little less. Now, the next thing I want to talk about real quick is implied volatility. So let's go back to another example. Let's say you have a call option with 30 days to expiration. Stock price is $53.50. Strike price or exercise price is $55. Risk-free rate of 3%. The call is trading for $1.43 and the put for $2.80. Now with options, remember there are 5 things that determine the value of the option. The strike price, the stock price, the time to expiration, the risk-free rate, and the volatility. And again, you can see those 5 key things right up here. However, of those 5 key things, we know what the risk-free rate is. That we can find that out from looking at treasury bills. I can find the stock price very easily. I get to choose the strike price. Now there are going to be limits, so I can't choose a strike price of $59.72, but I can choose one of 60, or usually $67.50 or something along those lines. Time to expiration, if I've got a calendar, I can count that. What I don't know is what that volatility is going to be. Because remember, it's not what volatility has been, it's what volatility is going to be going forward. So I can look up what the option is trading for. I can know the other things. What I don't know is the volatility. But if I know what the option is trading for, and I know the other 4 things, I can figure out what the volatility is. So let's take a look at this. We have 30 days to expiration. So let me set that up. My stock price is $53.50 and strike price is $55. So I need my strike price first, $55. Stock price, $53.50. The risk-free rate is 3%. I don't know what the volatility is. Now, when I set up this spreadsheet, it just had some value in there that was 30%. And that would give me a call option of $1.26 and a put option of $2.62. In my example, I want a call option of $1.43 and a put of $2.80. So let's go back. I want this to be $1.43. And I want this to be $2.80. Now, if we note, the call option is too low and the put option is too low. So I need to increase the call option and increase the put option. And the only variable that I'm changing is volatility. So 30% is too low. Let me jump up and try 35. Oops, now I've overshot it. My call option is too high. My put option is too high. I need to lower the volatility. Let's try 34%. Now you can see I'm getting pretty close there, but it's not quite there. Let's try 33%, and magically they come out exactly right. In practice, you're not going to find them come out exactly right. Call prices and put prices often have bid-ask spreads. You're not getting the true price all the time. So don't worry if it's off by a couple cents, but that's a way to figure out what the market is determining for volatility. So if you're trading options, what you're really trading is, do you think the stock is going to be more volatile or less volatile going forward? And you don't know the answer to that, but hopefully you've done some research on the stock and you can make some forecasts. If you think the stock is going to be more volatile, if you think volatility is probably going to be about 40%, then these options are too cheap and you want to buy the call or buy the put. If you think the volatility is going to be lower, maybe it's going to be 25%, then these options are too expensive and you want to sell the call and sell the put. So that's one way to play options, is to make predictions on volatility. Now there are a couple other things that I want to introduce real quick, and these are some additions that I've added to the spreadsheet. These are spin buttons. I wish I was smart enough to come up with this, but I didn't. I saw it at a conference and thought it was kind of a neat way to add it. But the spin button allows you to kind of play around with, instead of just change the numbers, you can move those numbers up and down. So if we look right here, call option 1381, put option 989. What happens if today's drop to 23? Call option goes down, put option goes down. What happens if the stock price goes up to 284.10? Call option goes up, put option goes down. What happens if volatility goes up? And you can play around with those. So you can kind of play around using these spin buttons to see what's going to happen to the call option and put option by changing the inputs. Note, we don't change the exercise price because once you've bought the call option, you're not going to see a change in that exercise price. The last little tab that I want to talk about allows you to take a look at the value of the option at expiration. That's this blue line. And so this is a call with a strike of 50. Anything at 50 or below, the option expires worthless. Once it gets above 50, then you make more money as the stock price goes up. This red line is the value prior to expiration. Now you can see the red line is going to be higher than the blue line, but it's going to be highest right at that strike price. As it gets further out of the money, it's not going to be worth that much more. As it gets further in the money, it's not going to get worth that much more. And the reason for that is, if the stock is trading at 40 and it jumps all the way to 44, hey, that's a huge movement in the stock. That's a 10% swing, but it's still going to expire worthless. So I need a big swing in the price. I need it to go up by 25% just to get even and then start making money. As the stock moves closer to 50, I don't need as big of a swing. If it's $49 and it goes up by 10%, I'm making money. So then we get up here, and now the problem is, as the call option gets more expensive, okay, here it's trading at $56. So my intrinsic value is already $6 and I've got to pay more. I'm putting more money in, so I get less leverage. I don't get as big of a bang for my buck anymore when the stock price goes up. So I get my biggest bang for the buck here. Now, technically, I get more leverage down here, but the stock price has to move a lot in order for that to pay off. Same idea with the put. Put, I get the right to sell at 50. Anything above 50, I don't want to sell it for 50. For example, if the stock's trading at 55, I don't want to sell it for 50. But if it's trading at 45, cool. I'd love to sell it for 50. I pick up $5 extra. But then the intrinsic value is going to be $5, so my speculative premium is going to be smaller. Just flip sides of the graph. Now what you see here is, let's drop the volatility. So it's 37%. Let me spin that down And notice what's happening to both of these red lines. The blue line isn't moving, but the red line is moving. The higher the volatility, the higher that speculative premium is going to be. That's true for the put and the call. As I get lower and lower, that kind of ties into the blue line. It kind of collapses onto it. If I move this back up to 30, now let me change the days. So 46 days gives me about a month and a half. What if that goes up to, let's say, 90 days? You can see now I'm getting more speculative premium. The difference between the red line and blue line is growing. And so as you play around with these buttons, you can see how that speculative premium is going to change. This, between the axis and the blue line, is the intrinsic value. The difference between the blue line and the red line is the speculative premium. So that's just a little graph you can play around with. And with that, we're going to wrap this video up. I know there was a lot there. It's a little bit longer. When I was teaching, they told us to try to keep videos to about 5 minutes. TikTok likes them even shorter. That was a lesson I never really picked up too well. So this is quite a bit longer video. Feel free to pause it, watch it over time, but that kind of walks through how to use this spreadsheet, and that spreadsheet is going to be up on my Substack. Thank you.